Hello and welcome back to our Freebie Friday video. It's Sade here again. Today I want to talk a little bit about capital gain tax and how it affects your real estate transactions. Capital gain is essentially the difference between what you paid for an asset and what you sold it for. So it's almost like the selling price minus the purchase price in a simple sense. And it applies to different kinds of assets, but I'm going to talk specifically about real estate because that's mostly what I deal with. I'm not a tax professional. This is for educational purposes only. So for your specific questions, make sure to talk to a tax attorney or a tax professional, and they know more about this topic, okay? So the capital gain happens when you sell an asset for more than you paid for it. Of course, it's not that simple because there are certain things that we have to look at when considering whether you owe the government any capital gain tax. And then there are also short-term capital gain tax and long-term capital gain tax rate. The rate is slightly higher if it's a short-term capital gain, meaning that you did not hold the asset for more than a year. So try, generally speaking, to hold the asset for longer than a year if you can. Whenever you sell the asset, that's when you realize the gain. So if I purchased the property 10 years ago and property values have been going up gradually over the years, it's evident that I might have some gain in there at some point, but as of today, if I haven't sold it, then it's not a realized gain, it's unrealized gain. So those are some terms you'll come across. Whenever I sell it, let's say I bought the property for $50,000 10 years ago, and now it's worth $350,000, and I'm able to sell it for $350,000. I have now $300,000 when you compare the selling price to the purchase price. Now, that does not mean that I cannot claim certain things along the way that would reduce the capital gain, the potential capital gain. So I can submit my receipts for the improvements that I made on the property over the years. The improvements affect my cost basis. So I've paid quite a bit to make it as valuable as it is now, and so IRS allows you to make some adjustments based on that. So keep your receipts very organized and keep them in a nice safe place so that you can apply that later when you do end up selling the property. So that's one tip. And then on top of that, when I sell that property, let's say I made repairs, renovations or improvements of $50,000, and I then ended up selling it for $350,000, that means I now have $350,000 minus my $50,000 that I paid for it, minus my $50,000 in improvements that I made. So instead of having the capital gain of $300,000, I now have a capital gain of $250,000 because of all the improvements that I made. Now, the IRS also allows us to have an exclusion that we can claim. If I'm a single person, the exclusion is $250,000. If it's a married couple, then the exclusion is $500,000 that they can claim. So in this scenario, I would have no capital gain tax to pay because I have exactly $250,000 in my capital gain, and so I can claim an exclusion if I meet certain criteria. I'm not going to be able to go into details about the criteria, but essentially it had to have been my primary residence, and I had to have lived there at least 2 years in the last 5 years before I sold the property. And there are a couple of other things, and you can check that out with your tax professional. And if you qualify for that, then you can get the exclusion. If you don't qualify for the exclusion, there are some exceptions that might apply. The IRS allows people to claim an exception for the capital gain tax if they were forced to sell. So for instance, maybe due to work, a health condition, or an unforeseeable event. An unforeseeable event, I'm assuming, means things like a hurricane or flooding, things that are outside of your control. So you might be able to actually qualify for an exception. So that's helpful to know, and that might bring down the total amount that you might have to consider. So let's say you actually ended up with a net profit after you sold the house and everything, and it was about $400,000, and you're a single person, and you don't have any home improvements that you made. So it would be $400,000 if you are qualified for that exclusion. Then $250,000 is deducted from that, and you would only be taxed on the balance of $150,000, assuming there are no exceptions and things like that. So the tax rate should be a little bit lower if you held it for more than a year. Remember that. So try to do that as a general thing to keep in mind, strategy to keep in mind. Also, if you're going to use the money to purchase another property really soon, you should look into the 1031 exchange, which allows you to identify a different property that you would use the proceeds from that sale to purchase. And in that case, the capital gain tax will not be triggered at all if you do it in the proper way. There are some conditions to that. We have a video out there, I believe, on the 1031 exchange, and you could also talk to a tax professional to get a handle on it and how it works, and that might apply to you. Additionally, if you're using a retirement account to purchase investment properties, that might be helpful in that the funds are not really going to you. Once you sell the property, the funds can then go back into the retirement account, and it doesn't trigger a tax event. But check all these things with your tax professional again for your specific situation. I hope this video has been helpful. Generally speaking, try to hold for more than 12 months. Keep all your receipts for the improvements that you made, and if you have an unforeseeable event or something that's forcing you to sell, consider that and see if you would qualify for an exception. So thanks for watching as always, and I will talk to you next time. Happy Friday.